we're like, oh, we don't want to put these straps on our structure. We don't want to put these shear walls on or whatever it is, because they don't see the need. And we're just like, man, if we had just one little earthquake to show them like, hey, this is important. We need to make sure this is in there.
Just to clarify, just enough to scare them. Not enough to do anything here, you know?
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Ducharme Wealth Management Podcast. Wow, if I could just get that one out really quick. Today I'm joined by Trevor Gardner, a friend of mine. I know him from back in the days when I was working in geomatics, and he is a structural engineer. He has done vertical, but nowadays builds a lot of bridges, particularly in Utah. And he's fascinated with risk. And what we've come to learn is that the overlap between the way that engineers think about risk and financial risk, there is philosophically a lot of overlap, and just the way that we think about that, perceive it, and how it affects our behavior as humans. And so we thought it'd be fun to just catch up on that and talk about philosophically risk. So not a lot of math in this one, but just some good food for thought, and hope you guys enjoy it. Again, as always, questions, comments, jokes for us, leave them in the comments, send us an email, whatever you want. And if there's an episode that you want to hear or a guest you think we should have on, go ahead and let us know, and we will try to arrange it for you. Enjoy the show. Tell me about this book again, Against the Gods.
Okay. Yeah. So it essentially goes through the history of our understanding of risk and risk management
As humans.
And it kind of asked the question why, we were around 10,000 plus years as a fairly advanced civilization. Why do we have this line between most of, history and then what we consider, like our modern history? What changed between, these thousands of years of just living the same, and then what did we do that basically changed the way we live and how we understood risk? And that's really what it came down to, is our grasp on risk and how we evaluate risk and then make decisions based on that evaluation.
Okay.
So
why does that lead to the change in going from, eating out of handmade pottery and dirt floors and all that to self-driving cars?
Right. Yeah. I think that's a great question. The first one is, why even worry about risk? And for most of history, we didn't worry that much about risk. We didn't really feel like we could control risk. We didn't necessarily feel in control of our own fates. And therefore, why even have risk management? Why worry about probabilities and risk when you don't feel like it's in your hands? And so it wasn't until like the Renaissance that we started asking those questions that we eventually made this leap to risk management, and the number system evolved with our understanding of risk. And so as we got, better, more advanced ways of just keeping track of numbers, that developed our analysis of risk and probabilities, and everything else kind of grew from that.
That's interesting. I remember I was probably in like middle school, early high school, somewhere in there. And I sort of had started having this internal dialogue personally in my own head. I don't know. I would like to think that's normal. But just like data and information is power. And I think that's maybe it's just watching tech companies sort of explode, right? Like, like what are they doing with all this anyways? What is Facebook? How are they going to make a business out of this? Right. And I think just coming to that realization, like tracking data and tracking numbers and processing that and databases. And like, there's so much useful information in the synthesization, like synthesizing all this. And am I right to understand that's kind of what you're saying, right? The book says like the more you understand the data and can track that in the number system and run probabilities, then you feel like you can make decisions based upon projected outcomes instead of it just being totally 50-50 every time, no idea.
Yeah.
Right. And then you can start making decisions differently, living your life differently, and then seeking out. And that somehow led to us developing technologies and doing all kinds of crazy stuff.
Right. And
it's interesting.
One part of the book I love. So it really started from gambling.
Okay.
And kind of, we've always gambled. And so we have these games, these dice games that have been around for as long as we know.
Thousands of years. Yeah.
And the question was asked, hey, there's an unfinished game. It looks like this person's winning. How do we divide the stakes if we were not to finish this game? And that question triggered the development of probabilities and understanding, he's this much more likely to win the whole thing. Therefore, we would divide the winnings this way between the two players. And just the thought of like, how do we divide it based on what we expect would happen kind of triggered this probabilities development, which is our biggest tool in risk analysis.
The distribution of possible outcomes.
Right. Yeah.
So you're and give a little bit of background. Why are you so fascinated about something like this? Right. Because you are like, I look at the world through numbers, and that's not a secret to anyone, right? Like, all right, investments. You don't. I mean, you don't do investments, right?
Right.
You may look at the world very much through numbers. So just give some context, because I think it's really important to understand. You're bringing a perspective to this that is not another, mutual fund company or insurance company or portfolio manager or anything like that.
Yeah.
Totally different perspective here.
So I'm a structural engineer, and I designed bridges. And I went into engineering like most engineers because numbers are perfect. They make so much sense. You know what I mean? Like you get perfect solutions. There's no ambiguity in our numbers.
And numbers are numbers.
And so it takes a lot of the variability out of what we do. And I think that's most engineers' perspectives, especially anybody going in mathematics thinks that way. The deeper I got into engineering, I took a engineering statistics class and realized how much risk actually plays into engineering and how that changes what we do. And from that class forward, I've been fascinated with understanding risk and how it affects the decisions I make as an engineer, and ultimately has a huge impact on our infrastructure, the cost that we put into our infrastructure, and how we develop codes, how we handle lawsuits. Everything about engineering is based around our understanding of risk.
So simplify that down for someone listening. Like, what is that? So you're designing a bridge. What's a decision that you're not to oversimplify what you do, but in most people's head, they think like, he's like, they have a picture of a cliff here and a picture of a cliff here, and Trevor's just getting on a computer and drawing isn't like you just draw a fancy looking bridge.
Yeah. Oh, that
goes across, right? Like, it isn't that, so where does the risk, I think the best way to describe it is through earthquakes. Okay.
So we have been measuring earthquakes for 90 years. The Richter scale was invented in 1930 something.
Okay.
So we have a pretty good grasp on the last 100 years and what seismic events have happened from there. The problem is 100 years in geology terms is the blink of an eye. We have it's almost like saying, I know what tomorrow's stock market's going to do by watching today's stock market. Like, it's just a very brief window into what actually could happen. And so we're trying to make a structure that will last 100 years based on what we've seen the last 90 years. And there's no real good way to say, like, this is exactly the type of earthquake that would happen or how big that earthquake would be. And so what we do is we try to build in factors, basically. So I'll find a seismic event that I think is close, design the bridge for it, and then I'll multiply it by 2. And you can imagine how much more expensive that is for a bridge. If I have to double the load because of this giant unknown in, the gap in our understanding, basically. Mm-hmm. And so it's just kind of fascinating what we've collectively decided, hey, this is the line in the sand that we're going to design to based on the limited data we actually have of earthquake events.
So you're pulling earthquakes that happen within a certain geographical distance from where the bridge is going to be built.
Right.
How do you determine the distance?
Well, and it's actually, so the amount of earthquakes is very small. So there's, the major earthquakes in the last 90 years, like there's a handful of them. The big earthquakes are what really gets us the data. A big earthquake acts differently than a smaller earthquake. And so we have, less than 100 earthquakes that we're trying to build millions of structures off of. Mm-hmm. And, most of them are in California. We have to kind of guess how that would, how does our rock strata, how does the, soil structure around this particular structure change with this type of earthquake? And there isn't a great way to say for sure what happens. And so we end up putting these large factors into the loads to try to, capture some of that risk.
Yeah, it poses an interesting question. Like if I'm trying to relate this back to like what I do in looking at finances, right? So that's where we get to use diversification, right? Mm-hmm. So we can say, okay, we have a distribution of possibilities, and in the simplest terms possible, right? Like we don't know if the stock market blows up and a meteor hits Earth tomorrow,
right?
But we understand that that's like, I don't know, a 17 standard deviation event or something, right? But like, so we can't eliminate risk altogether that way. But within like the 2 standard deviation normal, we can have bonds that should be producing income, an investment return, whether or not, equities and stuff are going up in price at the same amount, right? And when equities you do poorly, maybe your stock should be doing well from just a basic fundamental level, right? Like, but you can't say like, well, we're going to build one bridge with one lane that's, super overbuilt, and one bridge that should just be able to handle any little tiny shakes. And that will be the main bridge. But if that fails, then we've got this super robust one next to it. You can't like say, like, I'm going to diversify my bridge building according to, the probabilities there, right?
Yeah. And we do a version of that. So
interesting.
A good example of something where we, I guess, learned a lesson was in the 1930s and 40s, we built the Tacoma Narrows Bridge.
Okay.
I don't know if you've heard of that one.
Up near
in Washington.
Tacoma, Washington. Yeah.
Mm-hmm. So it's a suspension bridge. I think it was the 3rd longest bridge when it was built. Mm-hmm. It was a super famous engineer. He had, all the resources available to him, optimized the bridge as much as possible. It was a beautiful bridge. Mm-hmm. It looked great. Everybody thought it was going to perform well. As soon as it was built, I think it lasted like 4 months. And what happened was the dynamics of the bridge interacted with wind, and it basically created this weird aerodynamic frequency on the bridge that just compounded and compounded until it collapsed. And so it was this unknowable event to all engineers at the time. But there was no redundancy built into that structure. And so that's how we handle a lot of the unknowns too, is we design the structure and then we build redundancies into them. And that's similar to a diversification, I feel like, is this redundant system that, if this fails, I have this backup that will likely not fail. Or in my case, I design a structure to a certain standard, and then I also design the way that it fails. So for example, our bridges have concrete columns. We design these hinge portions in the columns that, if the structure fails, we know where it will fail and it won't cause a, catastrophic collapse. We're just trying to capture some of that risk. If the seismic event ends up being much greater than we anticipate, it's not going to fall over and, cause more damage. So
that's really, that's a really interesting risk management perspective. If this fails, can I capture a likely outcome of what that failure looks like and direct that failure in such a way that it limits the catastrophic outcome?
Yeah.
That's a really interesting risk management kind of standpoint.
And by focusing that failure point, we know, hey, that we're going to develop this hinge.
Mm-hmm.
However, we can have crews back in here, and in 3 or 4 months, we
put it back.
Repair it. And so we've mitigated a lot of that risk just by, knowing how it's going to fail. So.
Okay. So how do you, here's this is all just a philosophical conversation of what is risk. I think how do you define risk? What is risk to you?
I think risk is something unknowable. I really like the book, The Black Swan.
Okay.
And it really defines it not as an unlikely event.
Are you talking about Nissim Taleb's book?
Yeah.
Okay.
It's not really a unlikely as it is unknowable. And in hindsight, a lot of things make more sense, like the 2008 collapse or whatever it is.
Yeah, everyone saw it coming.
Yeah,
right. No one saw it coming, but somehow everyone saw it coming, right?
That hindsight bias really, hits us hard with that. And so what it ends up doing is we struggle to predict future events because of how easy we feel like it was to predict past events.
In this, similar to the idea of the generals always trying to prepare for the last war.
Yeah, exactly.
Right.
Yeah.
It's Howard. Do you know who Howard Marks is?
I've heard that name.
Famous investor. It has some really great stuff on risk. One of the things I learned from his work is the way that he defines risk is the presence of an outcome that is not intended. The possibility of an outcome that's not intended, right? So anything aside from your exact projection, anything is the presence of risk. And so I started stewing on this. I've been chewing on this question. And what I came to realize is to me, the way that I view risk is risk is like energy, right? You can't create energy. You can't destroy energy. You can just convert it or store it, right? But it's there, right? You can't, solar energy you're not making energy. You're just harnessing the sun's power, right? Yeah. Redirecting it, right? If I pick up my phone and hold it up, it has the potential energy, right, of falling on the desk, but I didn't create, that's the storage, right? Because I put the energy in to lift it. So, and so in trying to get rid of a certain kind of risk, you just take on other risk, right?
Yeah.
And you always have net total risk. I don't know. That's one of the things I haven't been able to figure out how to articulate total risk, 100%. If everything adds up to an amount of risk, it always nets out to 100. You always have total, full exposure. You have full risk exposure somehow. It's just what risks are you more comfortable with? Because what you can do is play the trading game, right? So in financial terms, you can be I'm okay with the risk of, the government inflating my currency. But I'm not okay with the risk of watching my account balance go down as much. So what I will do is, to balance that risk, I will buy bonds denominated in US dollars. Okay. Which gives me a limit to the upside potential. Thus, if the currency runs away, I get hosed. And I'm just going to hedge out a little bit by seeking a real yield. So I want to yield higher than the expected inflation rate. but now I have an obligation, right? A contract with, say, like the government, that they have to pay me in dollars a return. So it's a safe, a safer investment option, right?
Yeah.
But like you still have, like you have a lot of risk. Like if there is big inflation, and that happened to, say, like older Germans in after World War I, right? When Germany experienced hyperinflation, actually that's really something interesting to go like study. Is older Germans, they didn't like the stock market and they wanted something more secure, so they owned German bonds. And the German bonds, like you got smoked because you have a contract to get paid back in whatever, Reichmarks, and they're worthless, right? Wheelbarrow of them won't buy you bread.
Yeah.
You got paid back, it's worthless. Whereas the younger Germans bought like equities and stocks, and so they owned actual assets. And when the currency repriced, like they still own the asset and just got repriced into the new currency, right? So even though like something seemed safe, all of a sudden you have the tail end appear, and you still had the risk, right? You still had some kind of risk. I think about that a lot when people get into like annuity contracts, for example, right? And the risk there is, again, you have a contract to get paid in dollars. Okay. So same sort of risks as in bonds, but you have the risk of like, what if the insurance company goes under, right? It's like your contract is with them, not anything else. And it's not liquid. You can't sell it and, bail before the ship goes down, so to speak. The same way, not saying annuities are bad and people should never have them, but you can't say, well, this is truly a risk-free option. There is no risk-free option. It's always there. So if you're building bridges, like where does that manifest itself? Like, is that we can over-engineer it, but the risk is we don't have the same infrastructure for the population to transport as efficiently because we're spending 10 times more to build a bridge than we need to.
Yep.
Like, how do you balance that all of a sudden?
I think, we have this version of the statement, risk is expensive. And the less we know about an event, a force on our structure, the more expensive it becomes. And so, like, for example, the earthquakes, the seismic loads, anything in the Western United States is seismically controlled. And because of the unknowns around that, they're much more expensive than they probably need to be. If I was to just build a bridge to stand up, when the sun's shining, there's nothing's going on, it would be probably less than a third of what it costs now. But we're spending millions in infrastructure because of the unknowns, because of that risk.
Yeah, they're building two bridges. You might be working on these actually. The bridges for the overpass on I-15 right here in St. George.
Oh,
that UDOT project. Okay, cool. Then we can talk about it.
Yeah.
I heard it's like $150 million job overall, which like it's two bridges and widening the highway. It's $150 million.
Yeah. It's crazy how much is spent on infrastructure, and that's really what it's around is, like we have deep foundation systems. We have, a ton of redundancy built into our structures. We have to have these codes that we follow. And they all define that risk, and it is at least twice as expensive as it probably should be.
What about tail risk? Do you guys how do you think about tail risk?
Maybe define tail risk a little more.
3 standard deviations, an expectation of it being kind of 3 standard deviations plus.
I think that we have this expectation of what would happen, and then we lean on the code if something happens greater than that. So if an event happens that was not seen, but we still follow the code, then we're covered.
Well, like from an insurance perspective, but like just okay. So like if I said like a Black Monday, right? Have you ever heard of Black Monday?
Yeah.
Okay. It was like October 1987, Monday, market opens up. One day, market drops like 30% one day. Mm-hmm. That is a tail end event, right? Like that is no one modeled for that. No, right?
Yeah.
That was just it's like a freak thing,
Yeah.
And so if you look at like, okay, well, how do we build portfolio? How do we manage money? How do we get, return? How do we manage this risk? All this stuff. You could say, well, I don't want 3 standard deviation events. So I'm okay with, say, 10% loss. So I will always carry a put contract on my entire portfolio, 10%, out of the money. Thus, I'll absorb a loss of 10%, and wouldn't lose any money beyond that, right? But at a certain point, the cost of carrying that put becomes greater than like what you would possibly lose in the tail end event anyways.
Yeah.
Right. And so most people wouldn't ever just carry tail risk protection that same way in a portfolio. It gets really expensive, right?
Yeah.
So how do you start to think about it from like a bridge perspective and say in engineering, well, I'm going to butcher this because I don't know, like, I know what the Richter scale is, but we touched on it in like 7th grade and that was a long time ago. So like what's a crazy earthquake? Like a 7 or an 8 or something, right? That's like a crazy. And so in this 90 years of data, like how many 7 or 8s have there been?
A handful, not many.
Out of like 100. So you say like, okay, that's like maybe an 8 or a 9 is a standard, 3 standard deviation event. So at what point do you say like, well, we're just going to build bridges to withstand 6s.
Yeah.
And if the 9 comes, it happens, but we won't be able to build the bridges we need and advance the way that we need and hope. And, like 9 happens and some people die and that's just part of the cost. And,
one thing that we're doing is we're trying to put the risk, away from us. Basically, we're trying to put that on the owners. So what's new in the codes is we're letting the owner define what level of seismic performance they want to have.
So you can get the risk away from yourself as the engineer.
Yeah, and that's kind of, I mean, and that addresses that issue. You know what I mean?
Well, for you, but not
right.
Like the public.
Yeah, exactly. and an uninformed owner has no idea. Like, do I want my bridge to be barely standing after this earthquake event? Do I want it to be,
that's funny.
Several. Go ahead.
No. Go ahead. Keep going. Keep going.
The added complexity to that is the Richter scale doesn't always tell the whole story. So there was a seismic event in Mexico, a famous one, and it was actually the magnitude of the earthquake was quite small, but the waves were a really long period. Mm-hmm. And Mexico at the time, this was like 1985, they had a lot of 2-story brick buildings. Mm-hmm. And that exact frequency of the earthquake excited those 2-story buildings in such a way that they started compounding on themselves and just a total infrastructure collapse because of this. And it was a small earthquake.
Yeah.
But it was just the right frequency that it hit all these buildings that they had built. And so the Richter scale doesn't always accurately describe, it's not just designing for a 9 earthquake. It's designing your structure to, move differently in certain ways than what we would expect the ground motions to be. And so it's a little more complicated than I need to make it just this good. It's more of how do I get it out of a more vulnerable range than what I'm expecting to see, if that makes sense.
Yeah, I think that goes back to like, I keep trying to like put this into portfolio perspective to just synthesize it out. If I was building a portfolio and somebody said, I want all stocks, nothing but stocks, and you could say, okay, well, we could do that. We could manage the risk by, having some kind of options overlay or tactical or whatever, right? And that's the same as somebody that says, give me a building that just withstands a 9 Richter scale,
right.
Just give me that, just give me that one thing. And then you can do that. But all of a sudden there's this unforeseen event, maybe not tail end even, right? Like a Richter scale 4 wasn't a tail end earthquake,
right?
But it was enough to like, right. Major devastating effects. And so that's where I'm thinking like, that's a diversification of thought, right? And a philosophy, and to say, okay, even though that's what we're so focused on, there's other elements that we need to take into consideration outside of the boogeyman of the 9 Richter scale 9 earthquake, right? There's still the, wildfires and floods and the small earthquakes that have really weird frequencies that no one is anticipating, but that's a catastrophic event, right? And we want to try to hedge or manage around catastrophic events, because most of the outcomes within 2 standard deviations, we can anticipate around that, and the outcomes are generally acceptable. Right. You get into the 3 standard deviations, and now it's really good, or it's really, really, really bad.
Right.
Am I like kind of understanding that? Yeah. Is that like putting?
Yeah. And I think what we consider unlikely events are not always unlikely events. So I was around in 2005 when we had a 500-year flood event.
Okay.
And then 2 or 3 years later, we had another 500-year flood event, which tells us it's not a 500-year flood event. Mm-hmm. Our understanding of this range that we've set was wrong. You know what I mean? Like if you're having them every 3 years, it's a 3-year flood event. But we try to attach these timeframes to our events. Like, hey, this is and we do this with earthquakes.
Yeah.
There's a 2% probability that this earthquake will happen in 75 years. And that's the line in the sand. That's where we've drawn our understanding.
It's like the lie of averages, though.
Right. Yeah. And that's the problem with the limited data we have is as you're looking at, the law of large numbers.
Yeah.
We have no large numbers. Our sample size is tiny. And so we have to make all these decisions based on such a small sample size. And then we're constantly trying to adjust that as we get more data.
That's interesting that you say that, because I always feel that way about past performance in the stock market. Because I'm like, 100 years isn't that long.
No.
And then even if it is, the technology that drives the financial system has changed so rapidly over that 100 years, right? Like how markets behaved in 30s is not going to be how they behave in the 2030s the same way. You know what I mean? Yeah. There's just
Another thing I've thought of is, and it was in the Black Swan book, but he talks about how as a system gets more complex, the more vulnerable it becomes to these black swan events. And I see that a lot with our structures.
Yeah.
We're getting so optimized to these fictitious events that we are anticipating that it's getting very complex, very customized to this one specific thing. And we're losing some of that redundancy that would protect it against the unforeseen events.
The old worsification, if you will.
Yeah.
Right. I'm so diversified in what I'm doing. I've actually now accepted tail risk.
Yeah. Through
my expectation of everything working perfectly.
Yeah.
That's a dangerous one.
And it's over optimized to the point where the one event you really didn't see coming is just catastrophic.
Well, it goes back to you always have risk. There's always a form of risk. You cannot get rid of risk. Mm-hmm. So if you're optimized, loosely speaking here, air quotes, if you're saying you're optimized, you're not, because you can't be. And so you're kind of admitting, I've stopped paying attention to things that I think, like I have stopped trying to find things that could make this go wrong, right? I have stopped looking for things outside of the world we know or understand and look, you know what I mean? And looking for those things that could blow this up.
Right.
And I think I'm optimized.
Yeah.
Right. It's like, but we know that you can't get it, or at least, I mean, we don't know. My belief is you can't get rid of all risk. There's always, you can trade risk. So you're just introducing a different kind of risk.
Yeah.
You can't be optimized.
Yeah. Yeah. And I think that in my opinion, the idea of the complex structure being so vulnerable to, and it goes back to the Tacoma Narrows Bridge. They thought that was so optimized, and then it was this fairly normal event that just was catastrophic.
Global supply chains and COVID.
Yeah.
That's the one that that's the big one that comes to mind right now for
absolutely.
me, right?
Yeah.
Like, man, our supply chain is so optimized, you know?
Yeah.
And we're getting cheap labor here on that. And then, you know, getting it to this other part of the world where they're close to the natural resources and and all of a sudden it's like, you know, you shut it down and the whole world is coming to an end on, you know, there's shipping containers waiting at sea that can't even get unloaded, you know?
Yeah. And it trickles through everything.
Everything. And it all got affected, right? Everything got affected.
Yeah.
Including people all the way back to people's portfolios, right? Like because of the global supply chain disruption.
Yeah.
And the only thing that made it worse was Jay Powell calling it all transitory, which was, I think he might have reiterated that mistake again this week, but we'll see.
Yeah. That's a great example.
It's so interesting to me because you really do have to define out, okay, what is the likely, right? What is the probable? What is the possible? And then what is the unlikely, but still possible, right?
Yeah.
And how am I going to be okay with those risks, or what can I do to hedge or manage those risks, particularly in a cost-effective manner? And that's no different in portfolio management than in engineering, right?
Oh, absolutely. It's the same analysis.
There's no free lunches here, people.
Yeah.
You're right. You got to pay up if you want. You know what I mean? You pay in some way, whether it's explicit cost, right? You pay in over engineering the bridge, right? Or you pay in opportunity cost, or you pay in having to deal with the problem after the fact, right? Like there is some cost, right? There's no free lunch, right?
Yeah.
People might feel the appearance of a free lunch if they decided, I'm not going to hedge that risk. And then that risk was never realized, right? They didn't pay up to hedge the implied risk or possible risks. And then they just say, well, see, there's no risk.
Yeah.
But one of the things that I learned from Howard Marks's work that really internalized me is it's impossible to ever know how much risk you actually had or are dealing with, because I think like the example that he used, if I remember right, is like if you make an investment in a stock and 5 years from now it turns out great and it never even went down. Well, like somebody would say, man, that investment didn't have really any risk at all.
Yeah.
But it might have, like, there could have been days where it was 1 second away from going to zero out of nowhere and going into bankruptcy and you lose everything, right? It actually maybe had a ton of risk, but there's no way to tell because at no point did you realize the risk, right? Like the broad stock market in the S&P 500, you can kind of see that, right? When the stock market goes down or goes down a lot, like you are realizing at that point the risk. Mm-hmm. But if you're the person that bought at the COVID bottoms, like you thought you were a genius and you're like, this is a risk-free investment all the way up until January of 2022. You just thought like, this is just a money printer. Like I didn't make an investment. I just bought a money printer, it's just like, why even have a high yield savings? I'll just put it in the S&P 500, it's like just prints money until you realize the risk. But up until you realize the risk, you thought it was risk-free to a certain extent, right?
That translates directly to what I do. So I can under-design a structure, save a ton of money. And if nothing ever happens,
you're a genius, dude.
This I save so much money on this structure. The second that earthquake,
we're going to have this guy build every bridge.
Yeah.
He's so cheap.
And the owners love it. Like they're like, yeah, he saved us a lot of money. It was fine. You know what I mean?
Yeah.
Like
everything turned out fine.
And it really isn't until that structure gets hit by the earthquake or the hurricane or whatever it is that we understand, hey, he knew what he was doing. We're glad we spent this extra money on the.
But if it never happens, you're the guy that was the big waste of money.
So it's hard to justify. Yeah. And a lot of times, like, especially when I was doing vertical structures, we would wish for a earthquake because we're just like, nobody,
say that out loud.
nobody wants to do all this stuff. You know what I mean? Like all these owners were like, oh, we don't want to put these straps on our structure. We don't want to put these shear walls on or whatever it is, because they don't see the need. And we're just like, man, if we had just one little earthquake to show them like, hey, this is important. We need to make sure this is in there.
Just to clarify, just enough to scare them, not enough to do anything
right.
here, you know?
So yeah, I agree. I think that, I mean, it goes back to the idea that risk is expensive and that we're paying for that insurance. So
that's an interesting, like the dirty I word, insurance.
Yeah.
Because what is it? Like, what is insurance? And it's okay. First off, it's the most hated thing in America. That's that's really what insurance is. And oftentimes rightfully so. But what insurance is intended to be is a risk management tool.
Yeah.
Where you say, well, I don't really know how to handle hedging that 3-4 standard deviation event, that is unlikely, but not impossible, right? How do I get rid of that risk, right? And that's just where you say, I'll pay a little bit of money. And on portfolios, you don't want to do that over time. It's super expensive. But when you talk about like your personal life, something like life insurance, right? Like, yeah, it's a little expensive over time, but that is such an impactful event, right? Like you can't recover from that the same way.
Yeah.
And so, you buy life insurance, you do pay up for that protection.
Yeah.
But through the statistical analysis of the actuaries at the insurance companies, they're looking at the risk pool and they're utilizing the law of large numbers. And, even in insurance companies, there's no free lunches. Like they don't just, contrary to popular belief, just like print money endlessly, if they were, they'd be the biggest companies in the stock market, right? And they're not. They are large, don't get me wrong. But anyways, they know that they are going to have to deal with those tail end events. Those tail end events become their standard probabilities, right? And so they get paid to take that risk off your plate, and you can hedge that. But where insurance really sucks is when, as a culture, we've started saying, let's get away from using this as a risk management tool to address the left tail events that are so drastic, that are so life-changing, right? And let's use it to manage one standard deviation events.
Yeah.
The highly probable, right? And so all of a sudden you have everything's covered by medical insurance, right? And everyone has to have it. And now everyone can use and abuse and right.
Yeah.
And, auto insurance, everyone has to have auto insurance and everyone has auto insurance. So no one has that same personal responsibility of like, I get in a crash, my car's ruined, my life sucks.
Yeah.
I got to walk to work. So they're like, well, I got insurance. I'll text and drive.
Right.
You know what I mean?
Yep.
Well, when that risk is realized, what ends up happening is it messes with those actuary tables. And so everyone has to pay for that risk now. Mm-hmm. So just to interject my philosophy around risk and understanding that, why I think insurance like sucks and is hated so much in America is because a lot of insurance actually has deviated from this risk management plan to just a cost share plan.
I agree.
Right?
100%.
It's like we're all going to have to go to the doctor, so we'll all just pay through the nose for health insurance premiums and copays and all the rest. And we kind of all suffer together versus, if I said, hey, could I just get so what doesn't exist is, can I just get a health insurance plan that if I develop cancer, you guys take the bill, right?
Yeah.
Anything else, sniffles, flu, break my arm, that's all on me still, right? But can I just get that? And you can't get a health insurance that way, right? You can't get a very narrowly defined insurance plan to deal with the tail risks that you personally may or may not be able to take care of yourself through the rest of your risk management and your personal financial plan.
Yeah. The catastrophic things that would just be life-changing. You haven't mitigated those risks the same way.
Yeah. And people that have never dealt with the tail risks think they don't exist.
Yeah. And it's hard. I mean, it's hard to even grasp what it would be like if you haven't seen anybody live through it or live through it yourself.
I see this all the time in portfolio management. I will tell you, okay, it's not a secret that there is in the finance world this huge push towards like buying low cost index funds, right? And just like auto invest, you can't beat the benchmark, so just buy the benchmark, right? And there's a ton of flaws with this. First off, which benchmark is right for you and which index fund should you own, right? They're not all created equal, and they all have different purposes and they all have different fundamental economic drivers. And mathematically on bonds, it is like actually statistically more likely to actually beat the benchmark. And that's an easier game to win. Anyways, what they end up doing is in this endless cycle to limit costs and eliminate costs and right and try to increase your successful outcome by eliminating cost. They say, well, I will ignore essentially the tail events and just do this because in the middle, in 68% or 95% of probabilities, it'll be okay, right? It's acceptable. So I don't want to pay up to deal with anything that's on the left tail. No one gets mad about the right tail. Okay. No one gets mad. Ooh, whoops, made too much money, right? No one gets mad about that, but left tail, right? And so they do that. Now, for some people, that's not a bad plan, particularly I think like if you're starting out, but oftentimes like what I think it discounts is the fact that a lot of people in the industry and a lot of the people that lean so heavy into this narrative, they've never gone through a 1987 Black Monday, right? Mm-hmm. They did not go through the 1929 crash. A lot of them didn't go through the .com crash, and some of them didn't even go through 08.
Yeah. Right.
Like just the tail end events. Like a lot of people even look at like if I said, okay, you are fascinated by risk already. Have you heard of the Volmageddon of 2018?
No, I haven't.
Okay. If you're retired, that could really mess things up for you, right? Depending on how your retirement plan was structured and where you were taking money from and cash flows, right? Like if you're 25 and put money in a 401k, it was meaningless to you.
Yeah.
It didn't matter, right? But if you were like tail end events don't exist, well, until they do, and until like that tail event becomes impactful enough to you, now you really do have to address it.
Yeah.
And you have to have the difficult part is you have to have like the wisdom of hindsight right? to deal with it.
Yeah.
Well, I don't know. How do you deal with it then? You know,
the inexperience skews our perspective, and we don't we don't put the weight to it like we should, and we just like it's non-existent. It doesn't matter to us, and we don't worry about it, and like you said, until it does. And then that changes the way we look at the world from that point on. But sometimes the damage is already done at that point.
Yes. And some damage is recoverable, right? Some 3 standard deviation events, probably a lot of them are recoverable. Right. The bridge that had that, it at least had the breakpoints built in. A couple months down, you get it rebuilt. You're okay. Right. But, hey, we built it in a fire zone. And we built it out of wood to save costs.
Right. Yeah.
Like, I don't know, not so good. Right.
Yeah, absolutely.
But if the fire had never come, and I think this is the challenge, right? If it wasn't supposed to be a fire zone, so you're like, we'll save costs and build it out of wood, build this wooden bridge. Then you're like, as long as the fire never comes, you're a genius.
Yeah. And it kind of goes back to the idea of high risk, high reward too. Like taking on some risks sometimes can pay huge for an engineer. Like if my structure has a 75-year lifespan, I'm willing to take on a little bit of risk in what I'm expecting to see. I can save the owner a lot of money. And I think it's same in the financial world. Like if you're willing to take on that risk, there is some large rewards that are available to you.
Okay. If you're building a bridge and it's a 75-year bridge is the expected lifespan,
right,
what kind of risks do you get to take on in that time frame that can make it more lucrative?
I think that the biggest one is the earthquakes, just because that controls most of the design. And there is this standard where we say, hey, it's a 2% probability this earthquake will happen in this one spot. If you drop that down to a 5% chance or a 10% chance, the change in earthquake size is huge, and therefore your cost change is huge. And so just dropping that line in the sand just a little bit can save, hundreds of thousands of dollars.
So on a 75-year bridge, you're saying there's a 2% chance that you have this
Earthquake.
9 Richter scale earthquake.
Mm-hmm.
But if you say, let's just pencil that in at 1%,
Yeah.
you can save half your money, right?
Right. Yeah.
And so the upside to that is, if you're the guy building bridges, you can build twice as many of them.
Yeah. Yeah. And save, the funds can stretch a lot farther.
Yeah.
Handle more infrastructure.
Uh-huh.
And so it really becomes how much risk are we willing to take?
Yeah. What if we said this was a 74-year lifespan and the 2% falls in year 75? So let's just.
And that matters a lot. And you can, just that little change in risk is exponential.
It's interesting. It's like inflation expectations.
Yeah.
Have you ever seen like a financial plan that gets stress tested with inflation expectations?
I haven't.
Okay. I love trying to explain this conversation to people. People do not think like this, because somebody will say, how much return do I need in my, portfolio? And my answer would be something like 4 or 5%. Really? Like 4 or 5% real return. What do you mean? Like, there's a variable in there, which is, what is inflation? So if we say you need 10% over time, it's a meaningless number to me, because if inflation runs at 11%, you're screwed. You've lost money, right? Even though you think you've made money, you've lost money, right? But if inflation is at 0% the whole time, you knocked it out of the park like you would have never imagined, right? And so realistically, you got to say, okay, well, inflation is a variable, and we just need a real return on top of that. So now if you say, okay, well, I'm shooting for a 4% real return, right? And inflation is going to run at 4, so 8% return. Well, that's pretty reasonable. But there's this other investment that is really safe and makes 6. Why don't we do the 6? What's half the return? How is the difference between 8 and 6? You know what I mean?
Yeah.
6 isn't half of 8, but it's a 2% real return versus a 4% real return.
Right. Yeah.
And that's really what counts, is in the future, what can my dollars buy me in the future when I go to use them, right? And people have a hard time conceptualizing that, right? So like the difference between a 4% return and a 5% return is massive.
Oh,
The difference between a 44% return and a 45% return, not as big of a difference, right?
Yeah.
Mathematically on paper, it would like look the same magnitude, right?
Yeah.
1% is 1%, but in real terms, if your inflation expectation is 4% or 3%, the difference between 4 and 5% nominal return, or the return you sort of see on paper, this is a huge, huge difference.
Yeah.
And if you compound that out far enough, it makes a big, big, big difference.
Yeah. Oh, absolutely.
But people don't think about it that way at all.
Yeah. That's hard to conceptualize, because we see the number at the end, you know what I mean? Like, oh, I made X amount of dollars. I guess understanding how that translates to value changes.
I found that people have such a difficult time processing that and not getting distracted by the behavioral tendencies. That what I started doing when I illustrate out financial plans, and there's probably some CFP out there that's going to just tear me up for this or something. I don't know. Someone's going to be upset about it. But rather than showing people the return and then putting in an inflation expectation, right? And then like trying to discount that back to the present or something, right? and anyway, so you're trying to show somebody like, I'm going to inflate your costs and I'm going to inflate your portfolio returns. But now we're like in this weird world where you're like, yeah, so Trevor, when you retire, you're going to have like $10 million and yeah, you'll get like, a couple $100,000 a year income off that. And you're going like, dude, sweet. I'm gonna be so rich what I'm doing, like this is great. I'm gonna be living the gravy train in retirement. This is gonna be crazy. And then it's like, yeah, like I think you should be able to stay in your house and pay the utility bills with that. It's like, you know what I mean? It's like they can't, it's like once you inflation adjusted, you're like, that's not a lot of money per se. But today, right? We're talking about something 40 years from now or something, right? It's like, but today it seems like so much. And so people have the hard time adjusting that to the future. So like, instead of showing, like when I talk with people, like, what does my retirement look like? I always just try to address that behaviorally by just talking always in today's dollar terms. Yeah. So if my inflation expectation is 2%, I think we're going to get a 7% return or something. I don't model out like their portfolio and their income. And I just put no inflation growth on the expenses. And then just say like a 5% return. What does the portfolio grow to? And then what does the income on that sort of look like? Yeah. So that way they're always in like the today's dollars mindset. Yeah. But what I found is then sometimes it's underwhelming because like what they want to see is like, I want to see that it's going to be $10 million. And you're like, it will be, but not worth the $10 million you think, right? It's way, well, and the unfortunate part is oftentimes it's a conversation that leads back to like what you think you're doing and saving today is not, you're typically not saving enough. Right. Yeah. And to sum it all back into the whole, like there's always risk. So your risk isn't in not getting like in losing your money in the stock market. Like your risk is in never getting to the end destination because you didn't save enough, right? Like you have risk in like working forever and dying on Medicaid, right? Which is like, to me, like, that's riskier than not saving. Like that's a horrific outcome I don't want. Yeah. Personally. But anyways,
your perspective is much different. So one of my favorite quotes is, engineering is the art of dealing with materials we don't understand and making them withstand forces we can't analyze in a way that the public doesn't know the extent of our ignorance. So in another way of saying it, we're trying to cover up what we don't know as engineers. We want the public to feel very comfortable with their infrastructure and what we're doing.
Dude, you just described portfolio managers, man. So, we can't know. Yeah. We can't know for sure.
Yeah. And so we have to portray confidence. We don't want people to be nervous about being in a building. We don't want them to be nervous about driving over a bridge. But there are so many unknowns that we're trying to cover up. And so you're in this different perspective where you are educating people about risk. And that's something that I don't do a lot. So I'm curious your perspective of it.
I think what I just said is it's really hard to educate them about it. So you just try to give them the feel goods about it and just put it in terms that they understand. Right. When I just inflation adjusts everything. And so instead of inflation adjusting it to them and helping them understand a bigger number, I just show them a smaller number, but in today's dollar terms, right? So it just makes more sense to them that way. I think what you just said is actually really sums up like the way you construct a portfolio, right? Is like it's impossible for me to know if the Federal Reserve is going to start buying bonds tomorrow. Absolutely. Creator of the financial system, the whole thing goes to hell in a handbasket. I don't know. It could happen tomorrow. I don't know that for sure, right? Like there is no way to say we have this, and this goes back to like, there's no free lunch in finance. There's no way to say like, we have this perfectly positioned that no matter what, we make money, there's no risk. Yeah. You can't do it. There's always some kind of risk. Now the tails can get, fatter, right? You can have kurtosis or excess kurtosis, right? But like as portfolio managers, we just have to go on the data that we are given and understand,
Right.
which is wildly more than the public knows or understands.
Yeah.
We have access to data that they don't typically have access to. And because we're paid to do it as our jobs, we have access to time that they would never have, right?
Yeah.
Like, as smart as the brain surgeon might be, he doesn't have the time of day to think about how to construct a good portfolio and all the considerations, right? And so, he pays someone else to do it. And, we get paid to do that. And so that's how we get to spend our time, is thinking about those things on behalf of other people, which is fun. It's like, I love what I do. However, I think that's why they can't say, like, you can't guarantee somebody returns, because you can't know.
Right.
But now that you're saying it from the engineer perspective, I'm terrified driving home, because no one's ever said the engineer actually can't guarantee you it's safe to drive across a bridge. Like, like I wouldn't be able to, if somebody said, hey, your financial advisor can't guarantee you returns, you go, well, yeah, come on, everyone kind of gets that,
Yeah.
But if the engineer showed up and was like, I can't promise it's safe to go over this bridge, just so you guys know, it should be fine. But there's this thing called tail risk, and you guys probably don't know about it, but just disclaimer, it's in fine print actually on the edge of the bridge and in the contract there. Not my fault, right? You would go, holy crap.
Yeah. Yeah, absolutely. We portray confidence, but there is so much unknown that, it's very similar worlds, I think. So,
yeah. You just got to do the best with what you got, right?
Yeah.
Okay. I think it's such a funny hypothetical, not hypothetical. It's such a funny philosophical conversation, right? Around just like, as confident as an engineer is in building this bridge, is as confident as I am in my ability to build reasonable portfolios and help people get to their financial destination. It's like, but neither of us could be 100%. Like the engine, but like, by the way, just the engineer can't be 100%,
absolutely
100% certain.
No, there's a direct correlation.
Which is probably someone listening going right now, going like, that doesn't make me feel really good. And here's the deal: is like you should. It's okay to feel a little uncomfortable about that, I think.
Yeah.
Right. And I think what you should be most uncomfortable about is actually if whoever you're working with as a professional explicitly tells you they're 100% confident, right? That is probably the most concerning of all. From my perspective of risk, like the greatest risk of all is to not think there's any risk.
It's overconfidence.
Yeah,
I think that's absolutely correct. Being cautious of risk shows a level of maturity and education that you want. You know what I mean?
Yeah.
Because it's there no matter what you do.
Yeah. Well, there will be realized risk in the future that we were not expecting. With what I do, with what you do.
Yeah.
Both suck. Both change people's lives really quick. I don't know about you. Often keeps me up at night.
Yeah,
all the time.
Absolutely.
I can only imagine. Oof. Actually, I mean, I can't imagine. I very much can imagine. But interesting perspectives. I never would have thought an engineer had that level of thought around essentially like the same kind of risk.
Yeah.
Like thinking about risk the same way.
Yeah. Yeah. It's such a big part of everything that we do. You know what I mean? Like it seems like our economy, everything is driven off the analysis of risk and how we interpret that and what risks we are willing to take on.
One of my favorite things to talk about when it comes to risk is how academia has, in my opinion, destroyed so many people's intellect around risk through the quantification of risk with standard deviation. right? The bastardization of risk is volatility. Do you have any thoughts as like through the engineering lens? Is volatility ever considered? I don't know how that would manifest itself in engineering, but
I do. So, the law of large numbers says the greater your sample size, the more accurate your data is, or the better your number is, close to what's actually going to happen.
okay.
I say things like, there's a 75% chance this earthquake will happen. That 75-year period is totally made up. And we say that because of the small amount of data that we have, but we've barely been measuring earthquakes for that long. It's unreasonable to assume that represents the last 1,000 years. But that number gives us confidence. Just by putting it on a graph, we feel good about it.
But does it give you false confidence though?
Yeah. I think it allows us to communicate it in a way that gives other people confidence, but it's almost a
but if it's false confidence.
Yeah, it's a false sense of security.
That's standard deviation, man, in portfolio metrics.
Yeah. It's nice to see it in a graph, in a bell curve, or whatever it looks like, but it doesn't translate to the real world. Doesn't eliminate the tails. Yeah, agreed.
And the tails, there's a interesting white paper on portfolio return, like the portfolio risk. I could see if I could share it with you.
That'd be cool.
It's written by a guy named Ron Piccinini. He's a French guy, PhD in math, and essentially, like his white paper says that I think it's something like 95% of the returns of a portfolio over time are driven by the tails, right? And so, from a risk management perspective, your best way to get to the desired end outcome, your best path at that experience over time, is to manage risk to the left tail expectations, right? So how do you eliminate or manage what, a portfolio in a normal year, like, really good year up or, little down, little market correction, it's all meaningless, right? Like what really matters is how do you avoid 08?
The big events.
Right. Yeah. How do you avoid, right? And so when those events happen, what does a portfolio do? Like what is your expectation at that point? And that's how you would manage risk. And I think he coined the term expected tail loss.
Cool. I like that.
It is a really interesting white paper. I've met him.
Cool.
And yes, definitely a smart guy.
Yeah.
We adopted that the way that's quantified in our risk management approach, but the hard part about that is that if you're managing risk to the tail loss, and that's over time, it goes back to the conversation earlier of like, what if it never happens? And so if you're building your portfolio to, well, I'm not going to have the like 08, right? Or I'm not going to have the, I don't want to use the words like not have. I am building this to try to avoid that or have a different experience in that tail event, right? Like until it happens, you might look like the dumb guy.
Yeah.
Right. You might look like you're the underperformer, right? Or you're the
the words we get called are over-engineered.
Yeah.
We over-engineered it.
Yeah.
And contractors yell at us all the time for that.
Yeah. I've heard that. And then, until like, and so for 3, 5, 7, 10 years, it's like, man, it's like, and then all it takes is 1 year to go from I underperformed the whole market the whole time to way outperformed.
Yeah.
Right. Like that's how significant, like that's what his paper basically says is like that event is so impactful that it can change everything.
Yeah.
Interesting.
Cool.
And, but wait, I'm not done. that goes back to the conversation of you still can't eliminate all risk. So the challenge that like I still have in my business with clients is, okay, I can have math that says I will get most efficiently or most effectively from point A to B with what I believe to be the least amount of risk because I'm managing the left tail 3 standard deviation events. And I believe the math on that indicates that over a long enough, time period, given the realization of those 3 standard deviation events in the world, at some point, it will lead to a better outcome, right? But if that takes 15 years, and clients are thinking always behaviorally, there's a lot of stuff to show clients think about or investors think about the last 3 years, and so you can't, they don't stay the course to the full 10 years or 15 years or whatever it takes. Then they've reintroduced a whole new level of risk into their portfolio in which they don't stick it out long enough, right? And they reintroduce tail risk all at the wrong time by changing course. And so now they don't, get to where they're trying to go, and you have sort of failed as an advisor. So then you have to balance that risk, right? Like math matters, but also get clients staying involved and staying the course over time also matters, right? Like behavioral, you have to manage behavioral risks.
Kind of manage those expectations a little too. And
like if behavior didn't matter, investing would be really easy.
Interesting.
Yeah. If behavior was like, behavior didn't exist, investing would be way easier.
Huh. That's very interesting.
But it absolutely matters. They're like probably the most important piece that does matter.
Fascinating.
But it goes back to like, so if you over-engineer every bridge, and eventually they're just like, Trevor, that guy's the over-engineering guy.
They won't hire me.
I got, Johnny Quickcrete down the street, and he's slapping up bridges in 3 days for me.
Yeah.
With some rebarring Quickcrete, and it works.
He's the obvious choice. Yeah.
The obvious choice, man. Trevor, you know what I mean?
Yeah. Yeah. And until something bad happens, I will look like an idiot, So.
At least you'll be handsome while you do it, man.
Thanks.
Man, risk.
Yeah. Fascinating. That's cool.
It's a real pain in the ass.
That's true.
That's all it is.
That's funny.
It's the philosophy that drives it all, though.
Yeah.
Like going back to that book, man. Okay.
Cool. No, that's a cool conversation. I like this.
I have more to think about. I've got more to think about now. It's a never-ending dialogue in my head.
Yeah. And it's always changing.
So given what we talked about, let me put it back on you. Like your final thoughts, like how do you now as somebody, as just somebody that's just like you're not a financial person, right? You're an engineer, but you're late 30s
or your mid 30s, yeah.
mid 30s. Like you gotta manage your finances and be an investor, right? So now to swap like engineer lens for the investors, like what's your perception now of managing risk? How does that overlap, and what's your view on it at that point?
It's interesting you said that 3-year period, because I kind of like, as I think about my perspective, that's what it's like since 2021, 22, like what has the market done and how can I prepare for that?
Mm-hmm.
And so even as much as I know about risk on the engineering side, it doesn't really translate to my financial decisions. And so I think it shows how non-intuitive understanding risk is. Cause I feel like I do understand it fairly well, but it doesn't really change how I would make financial decisions.
Behavioral risk.
Yeah. Yeah. It doesn't necessarily change that.
Okay.
So yeah, I think I would be in the same boat as your other clients. You know what I mean? Like kind of at the mercy of, what you would say. And
No one's forced to be at that mercy. Okay, well, all right. I'll stick to building portfolios and you stick to building bridges, and the world will probably be a safer place. So cool. Well, this is fun. I appreciate you reaching out. That was like,
yeah, that's cool.
It's fun. Anyone listening, like if you have comments on this, if you think I'm wildly wrong about something, if you think Trevor should engineer bridges differently, I don't know, drop some comments.
Yeah, I'd love to hear it.
Reach out. We'd love feedback. If anyone has some interesting thoughts, like they got some follow-up points to that, I am happy to have this conversation again with someone else. I am happy to actually come back, and me and you could come back in and have somebody else join us if somebody feels so inclined. Awesome. That would be an interesting take.
Yeah.
So yeah, let us know. And if anyone's looking to have some bridges built,
let me know.
let Trevor here know. If somebody has questions for you, Trevor, I mean, are you on social media anywhere? Do you have a website? You want people to reach out to you? You want to be left alone?
Yeah, I mean, LinkedIn is probably my best access. So.
All right. Trevor Gardner on LinkedIn.
Yep.
in Southern Utah.
Yeah.
You have your firm listed, that your engineering firm that you work with?
Yep.
What are you I don't know if you can say that.
It's Klophouse and Associates.
Klophouse and Associates.
Yep.
Okay, cool. All right. Trevor Gardner, Klophouse and Associates on LinkedIn, my friends.
Yep, that's it.
Okay, cool. Well, thanks everyone for tuning in. We'll see you next time.